welcome to Clatch Radio. Today, that's July 10th, 2025, we're diving into, well, the pretty dynamic world of investing right now. You look at the S&P 500, it's pushing into record territory. We've got tech giants like NVIDIA hitting, what, a $4 trillion valuation? It's pretty staggering.
It really is.
Yeah.
But there's this interesting contrast, isn't there?
Yeah, exactly. That's the paradox. The VIX index, our main volatility gauge, it's actually down. But you still feel this uncertainty swirling around tariffs, inflation.
Right. And the Fed's just holding steady. Yeah. Rates are still at that 4.25% to 4.5% band.
Holding steady. So our mission for this deep dive is really to unpack what's shaping these markets. We want to look at how different generations are navigating things, especially with this big surge in options trading.
And how quantitative strategies are playing a bigger role in all of this. It's fascinating because underneath those big market trends, investor behavior itself is really changing. That YouGov report, it shows 64% of Americans are likely to invest. But the really striking part
What's that?
Is that 55%, over half of the people planning to invest in 2025 are Gen Z and millennials.
Yeah.
That's a huge demographic shift.
Wow, 55%. So are they just investing more, or are they investing, differently? Different assets, different approaches?
Oh, absolutely differently. And crypto is like the perfect example. Get this. 83% of all investors see crypto as risky. We all kind of know that.
Sure, it's obvious.
Yet 42% of Gen Z own crypto. 42%. That's nearly 4 times the number of Gen Zers. Just 11% who have a retirement account.
4 times? That's pretty wild. What about millennials?
Similar trend, though maybe not quite as dramatic. It's 36% of millennials in crypto versus 34% with a retirement account. Still more in crypto. And looking ahead, 65% of Gen Z actually plan to invest more in crypto in 2025. Definitely points to a different perspective on risk, doesn't it?
It really does. So what gives them that confidence, you think? Especially if they acknowledge the risk.
Well, part of it seems to be self-confidence. The report found Gen Z at 70% and millennials 68%. They feel more confident managing their own investments compared to, say, the average investor, which is 60%.
Okay, so they trust themselves more.
Right. And that leads to fewer of them using financial advisors.
Yeah.
Only 32% of Gen Z work with one. Compare that to baby boomers, 51%. Over half use an advisor.
That makes sense. They grew up with tech. Maybe they feel more comfortable doing their own research online, using apps.
Exactly. They're navigating it solo, often through newer channels.
And the data shows what they prefer, right?
Yeah.
You mentioned Gen Z showing a big jump in interest in stocks, like a plus 16.4 growth score.
That's right. A sharp rise in interest there. And real estate platforms, too. Those are really trendy for Gen Z. Saw a plus 10.2 growth.
And how they access this stuff. Crypto exchanges are huge for Gen Z. 48% use them versus just 29% overall. That's significant.
It is. Meanwhile, for older generations like Gen X and baby boomers, the growth area seems to be more in options and futures trading. We saw growth scores of plus 3.4 and plus 1.2 there.
Which brings us neatly to the options market itself. Because that's not just older generations. It seems like everyone's piling in.
Oh, it's booming. Absolutely booming. January 2025 set another record. 1.2 billion contracts traded. That's the 6th year in a row it's broken the record.
6th year? Wow. What's fueling that?
It's a few things. Definitely the rise of those zero-day-to-expiration options, the Zero-DTEs. People using them for quick intraday bets.
Right, the super short-term stuff.
Yeah. Plus, you've got just generally more retail traders active in the market and also institutional investors. They're using options more for risk management, especially with all the geopolitical uncertainty floating around.
So let's talk strategies quickly. These Zero-DTEs, which are, over half of S&P 500 options volume now?
Yeah, a huge chunk.
People use them for high leverage, really short plays, right? Things like iron condors, which are kind of complex, or just simple puts and calls going one direction or the other.
Exactly. Or you have things like credit spreads, maybe for trying to get some steady income with a defined risk.
And for the longer term.
Then you've got LEPS long-term equity anticipation securities. Those are popular for, bullish bets on sectors like AI or maybe renewable energy. Gives you time to ride out the bumps.
Okay, so lots of different approaches there. And all this activity, this data, it connects back to quantitative analysis, right? The quant approach.
Precisely. Quants rely heavily on math, statistics, algorithms. They use enormous amounts of data, including all this trading data, to build automated trading models. The idea is to find patterns, maybe historical price movements, that trigger automatic buys or sells, like buy at $25.50, sell at $29.50, purely based on the numbers, not necessarily the company fundamentals.
So less about what the company does, more about how the stock price behaves.
Often, yes, though it can also be used for sophisticated risk management, like in risk-parity portfolios, trying to balance risk across different assets. And the VIX index you mentioned earlier, that's a key tool here too.
Because it usually moves opposite to the S&P 500.
Right, that historical inverse relationship makes it really useful for hedging, for managing portfolio risk in these quant strategies.
Okay, so wrapping this up, what does this all mean for you, the listener, trying to navigate all this? We're seeing these big shifts. New generations, tech platforms, higher risk stuff like crypto and options becoming, well, almost mainstream.
Yeah, but at the same time, those traditional worries, inflation, tariffs, they're still very much in the picture. The Fed holding rates steady kind of underscores that, doesn't it?
It does. It shows that even with all the data, all the algorithms,
The human element, economic policy, unexpected global events, they still hold a lot of weight. It's a balance.
definitely a balance. Which leads us to a final thought for you to consider. How well can a purely mathematical, data-driven investment approach, like quantitative analysis, really hold up against those truly unpredictable human factors? Things like sudden geopolitical crises or major economic turning points. What stands out to you about finding that right balance between cold, hard data and perhaps human intuition in these really dynamic markets we're seeing today? Thank you for listening to Clatch Radio.